might you think about long-term averages if you're an investor? Well, here to talk with me about that is David Shotwell. He's a financial planner with Shotwell, Rutter, and Baer Financial Planners. David, welcome.
Thanks, Bob. How are you today?
I'm great, and I'll be even better after you sort of walk us through how investors need to think about long-term averages.
Yeah. So in the investment world, we're bombarded with statistics, right? And it's pretty common for people to look at past performance and try to extrapolate different comparisons. And it's pretty common for clients, especially newer clients, to like look at a portfolio and see one thing's down, one thing's up. Why are we keeping, this? Why are we keeping that? And so what we try to do is help people think about like what can we learn from long-term returns? And first of all, if your portfolio is diversified, there's always going to be something that isn't performing as well as everything else. That's just the nature of diversification. What we like to do is frame up the conversation that if the market's been doing very well, your portfolio should be doing well too. And what's really important is to think about, okay, if my portfolio is up 12% this year, but a long-term average for a portfolio like mine is 8%, what does that tell us about the future, right? And if the long-term averages hold true, and they tend to hold true over time, right? That's the nature of how these things work, then we've got to expect some downside if we've seen outperformance for a while. And just trying to keep that in perspective.
Yeah. So when you think about investing, I think I think about the historical averages, and forgive me for jumping around a little bit, but I think about
Sure.
for the long term, small cap stocks have done 12% on average since the late 1920s, and large cap have been done 10%. And then if you look at a balanced portfolio of 60-40, maybe it's somewhere between 6 and 8%, perhaps somewhere around there. And most people don't have 100% of their money in equity, so it's almost the wrong comparison to say my return was 8%, but the long-term average of small caps is 12 or 10%. And just as you talk to investors and your clients, do you have to sort of frame it in that sense that we need to look at like our portfolio as it's allocated, not as you're comparing it to S&P or NASDAQ?
Yeah, absolutely. You've got to make sure you're doing an apples to apples comparison. And so, yeah, that uh, like most, folks in retirement planning like myself, most of our clients are, we call the 60-40 portfolio the Goldilocks portfolio. And that's pretty much held true that that's where most of our clients end up within reasonable distance. And so, if you're 40% in bonds and 60% in stock, then comparing yourself to the long-term average of large cap stocks isn't going to get you very far and or be very meaningful. What you want to look at is taking the weighted average return. And you can keep it pretty simple for this purpose. I like to use, just to kind of get the conversation started, just use 10% for the portion that's in stocks and 5% that's for the portion in bonds. And yes, if you've got small company stocks and international stocks and different things in there, it's going to vary from that a little bit. But don't let those details bog you down too much.
Yeah. So in the article that you wrote for Retirement Daily, David, oftentimes people are told past performance is no guarantee of future results. But you have this opinion that the average at least can tell you a little bit about what the future holds in store.
Right, right. So, back to that idea of that 10% average return for the stock market at large goes back through the entire history of the stock market. And that's going to include, good times, bad times, all the in-between times, right? And so if you follow that back and you think about the fact that that seems to hold true based on the economic growth of the world, then unless something has like really changed in the dynamic that we can't really account for in the here and now anyway, then if your portfolios, if your stock funds are up 20% and the long-term average is 10%, at some point it's going to underperform that. and vice versa. If we're in the middle of a nasty market, you can also take comfort in the fact that, hey, at some point, if I'm down 15%, boy, we're going to have a couple good years here where we make that up, probably, right?
So I want to talk about this notion of outperforming the historical average, and this and the possibility that people may say, let's take money off the table and liquidate my portfolio. Talk more about that.
Well, there's while there's predictive power in that, in the sense that at some point these things will happen, we will see reversion to the mean. It doesn't tell us when, and it doesn't tell us how. If you're seeing outperformance, getting back to the mean might mean a couple blah years where it just doesn't live up quite to the averages. It can mean one really bad year that we all get dizzy from, and then it is over. We're never going to know. And there's an old cliche in the markets that the markets can stay irrational a lot longer than you can stick with it, right? And so just because we're seeing that doesn't mean you're ever going to be able to tell when that change is going to happen.
So when you think about another topic that comes to mind is I often receive from major investment firms their expected rates of return for the next 7 or 10 years. In some cases, they're dramatically lower than what the historical averages are. Do you place any weight on these kind of predictions?
Well, usually, without specifics, it's hard to say. But I always take those with a grain of salt, because um, they generally are all over the map. At any given point, you can find different predictions that sound logical and reasonable based on very good assumptions, and they'll be completely different. And it's a fun game to chart out, like at the beginning of the year, where all these firms say the market's going to go in January, where we'll be at the end of the year. And um, it, it, it's uh, the best thing to do if you're going to make a prediction is make it loud and make it often.
And if you're
You
wrong
know,
50% of
that
the
seems.
time, you're fine, a pretty good average. I mean,
Yeah,
I always say
yeah,
Ted
yeah.
Williams got into the Hall of Fame with a 400 batting average. So if you're right half the time, that's pretty
hmm
good in the investment world.
You know, I think most macroeconomists would be thrilled with a 400 average. so, so yeah.
Yeah. So we covered a lot of ground. Anything we missed as we think about like how investors should think about long-term averages?
Just keep in mind that that's probably as good as you're going to do as far as prediction goes. In the short run, who knows what the market's going to do tomorrow? There'll be global headlines, there'll be economic headlines. We don't know what they are ahead of time, and the market will react, and who knows what'll happen. But when you take that and run it out over time, patterns emerge that, while don't tell us like magnitudes and timing, do tell us where we should end up over the long run.
Well, David, I so appreciate you writing for Retirement Daily and speaking with us in these videos where you share your knowledge and wisdom with our viewers and listeners. So thank you very much.
I appreciate the opportunity, Bob. Thank you.